Right. So we need to be really careful with these payroll numbers in that it's telling us something about labor demand is slowing, right? And that piece, that contraction, that what it's a recession, that's about demand falling short. We also are in a period, it's very hard to measure, but we are in a period where it is likely that the labor supply is also slowing. We've had dramatic reductions in immigration. We also have an aging workforce, right? So those two things can come together and get you lower numbers in terms of payrolls. The bad piece, the thing that like the Fed might want to react to would be the weaker labor demand. That structural piece, that supply piece, that is not something the Fed reacts
Right.
to. So while these payroll numbers are pretty eye-popping, some attention, these are weaker than we thought in the revisions. Look at that unemployment rate.
Right.
It ticked up, but that is still a
Right.
good, that looks like balance still.
2-year yield was a negative 10 basis points. It's now a negative 14 basis points. To translate, folks, yields are lower, bond price is higher. The 30-year bond even is higher here, modeling out that September meeting. Claudia Sahm, if I look at the data, my amateur answer is I want to smooth out to a 3-month unemployment rate. That statistic is 35,000. I mean, the president's going to go to Jerome Powell and say, we're well under 100,000 on a 90-day jobs report. Can you say, okay, it's time to adjust? Could we have an intermeeting rate cut?
I think that is highly unlikely. Again, the unemployment rate is 4.2%.
Fair.
Right?
Yep.
The Fed, there's movements like the Fed can't change the labor supply. They can't, like, if there's structural changes, that's not their remit. That's not their tools, right? And so they're going to be watching very carefully. The unemployment rate, it did move up. If it continues to move up, if it picks up pace as it moves up, like these are real signs. The payrolls, they're telling us something, and there certainly is a risk that there's more labor demand, but this is not, no one data release would tend to, bring the Fed into intermeeting action, but this is not, just the broad brush, the top line
Right.
numbers. This doesn't look like that.
Paul, in August in Michigan at Ann Arbor,
Yeah.
there's a junior Claudia Sahm
Yes.
in graduate school who's going to look at the immigration overlay on
Yeah,
this.
I know.
That's really what's
I like
going
to
on
see
here.
that. Claudia, Tom and I try to, kind of look at things on a rolling basis here, not get too caught up in 1 month here, 1 month there. The non-farm payroll 3-month average change, that's also notable here. It was 150,000, kind of poking along at 150,000 last month. That gets revised down to 64,000. And then this month comes in at even lower, 35,000. I don't know. That seems like something's going on out there. How do we think about that?
Right. Yes, like in smoothing through the numbers, but again, these payrolls to piece apart what is, supply
Right.
and demand. And it's very hard. Like the immigration numbers, we don't have good numbers in real time, but we see border crossings have basically stopped
Yeah.
for unauthorized immigration. And the immigration, whatever, you think about the policies, like it was an important driver of labor force growth and these job gains that we needed to be making, in years past to get the
Right.
unemployment rate low. Well, it's reversed, and it's done so very suddenly. So I don't want to write this all off, and the Fed certainly wouldn't write this off. There is a sign that we've got some weakening of demand. We see that also in the GDP numbers, the consumer spending. We've seen some softening. So like it's this question of how do you pull the two pieces apart? And one rough way to kind of see where you stand is to look at how the unemployment rate is balancing out. The people looking for work, are they still at about the same rate finding
Right.
that work?